What if I told you that while millions of people are losing sleep over volatile crypto crashes, options trading, and tech stocks dropping 20% in a single afternoon, someone else is receiving a guaranteed payout check every single quarter for doing absolutely zero work? Right now, you are trading your most valuable asset, your time, for money. You wake up at 6:30 a.m., sit in soul-crushing traffic, endure relentless workplace stress, and at the end of the month, inflation systematically eats away whatever savings you managed to scrape together. You are running on a financial hamster wheel. You feel like no matter how hard you work, the game is rigged against you. And you're right, it is rigged if you keep playing by their rules. While the crowd is chasing the next flashy 100x meme coin or burning their hard-earned cash on hyper-hyped tech stocks, smart money is doing something radically different. They are quietly buying up boring, unglamorous corporate giants. Case in point, buying 1,000 shares of Johnson & Johnson. It won't make you cool at dinner parties. It won't give you a viral screenshot for social media, but it will deposit thousands of dollars into your bank account year after year, completely on autopilot. Today, we decode the stealth wealth engine that the top 1% use to retire decades early. Welcome back to Economy Decoded. To understand why most retail investors remain broke, we first have to dissect the grand illusion of the modern stock market. Every single day, financial media feeds you a specific lie, that fast wealth is the only wealth worth having. You see 20-year-olds on social media claiming they made $500,000 trading options overnight. You see tech startups valued at billions of dollars without ever generating a single penny of actual profit. What do? You buy into the hype. You chase momentum. But here is the brutal reality of that strategy. High volatility cuts both ways. When you buy a company built purely on speculation, you aren't investing. You are gambling. You are sitting at a digital casino, paying high transaction fees, suffering heavy capital gains taxes when you trade constantly, and draining your psychological bandwidth staring at line graphs every 10 minutes. The fundamental misconception held by 90% of retail investors is thinking that high stock price action equals wealth creation. It doesn't. Real wealth isn't built on speculative capital gains that vanish during a market correction. Real wealth is built on cash flow. Enter Johnson & Johnson. When people hear Johnson & Johnson, they tune out. They think, that's a granddad stock, that's where money goes to sleep. They think Johnson & Johnson is just baby shampoo and Band-Aids, products with paper-thin margins in a hyper-competitive consumer market. Because it seems slow, dull, and unsexy, retail investors ignore it. They walk away in search of hyper-growth. And in doing so, they walk right past one of the most powerful, predictable, cash-generating monopolies in human history. It's time to perform a financial autopsy on Johnson & Johnson and expose the secret mechanism that turns a boring healthcare stock into a perpetual cash-printing machine for your portfolio. First, let's look at a statistic that will blow your mind. Out of thousands of publicly traded companies in the entire world, do you know how many carry a AAA credit rating from Standard & Poor's, a rating higher than the sovereign debt of the United States government itself? Only two, Microsoft and Johnson & Johnson. Let that sink in. Financial rating agencies literally consider Johnson & Johnson's balance sheet more stable than the government that prints the US dollar. Why? Because while governments run on deficits, Johnson & Johnson operates an enterprise structure designed for absolute economic invincibility. Most people don't realize that Johnson & Johnson recently spun off its consumer health division into a separate company called Kenvue. What remains inside J&J are two elite, high-margin powerhouses, Innovative Medicine and MedTech. These aren't products you choose to buy. They are products human beings literally cannot live without. We are talking about breakthrough oncology treatments, immunology drugs, cardiovascular technologies, and robotic surgery systems. When the economy enters a recession, what happens? You might cancel your Netflix subscription. You might stop eating out at restaurants. You might delay buying that new car. But if you need an artificial hip replacement or life-saving oncology medication, you pay for it. The demand for J&J's core products is almost completely inelastic. This inelastic demand creates a predictable, massive ocean of free cash flow. And here's where the secret mechanism pays off for you. Johnson & Johnson is a dividend king. That means they haven't just paid a dividend for a long time. They have increased their cash payout to shareholders every single year for over 60 consecutive years. Think about what was happening over those 60 years. The Vietnam War, the 1970s stagflation crisis, the 1987 Black Monday crash, the 2000 dot-com bust, the 2008 global financial crisis, a global pandemic in 2020. Through every single catastrophe, market crash, and economic downturn, JNJ didn't just keep paying its shareholders, it gave them a raise. Let's run the math on 1,000 shares to see how this translates to your life. If you own 1,000 shares of JNJ, you aren't waiting around hoping someone else will pay more for your stock tomorrow. JNJ pays out cash directly into your brokerage account every 90 days. At a baseline dividend yield, those 1,000 shares generate roughly $2,100 to over $4,000 per year in purely passive income, depending on your historical entry price and compounding schedule, without you having to sell a single share. When you sell a normal stock for profit, your asset is gone. You killed the golden goose to eat one meal. But with dividend growth investing, you keep the goose. And every year, the goose lays bigger eggs. Here is the shocking revelation that changes everything about how you view your money. The drip effect. Dividend Reinvestment Plan. When you take that cash payout and automatically use it to buy more fractioned shares of JNJ, you trigger exponential compounding. Next quarter, you don't own 1,000 shares, you own 1,010 shares. That means your next dividend check is bigger, which buys even more shares, which yields an even larger check. You have created a private financial engine where your money works 24 hours a day, 7 days a week, 365 days a year, without taking sick leave, without complaining, and without asking for a break. So, how do you take this technical breakdown and use it to transform your own financial trajectory starting today? You don't need $1 million to start, and you don't need to buy 1,000 shares all at once. What you need is a complete shift in your financial architecture. Here is your 3-step action plan to transition from a consumer to an owner. Step 1, stop buying price action. Start buying business moats. Stop asking, will this stock go up tomorrow? Start asking, does this company own essential infrastructure or intellectual property that the world will desperately need 15 years from now? Look for companies with high cash reserves, low debt-to-equity ratios, and a history of raising payouts through recessions. Step 2, turn on automatic compound growth. You do not need to time the market. Set up an automatic transfer every month, whether it's $50, $500, or $5,000, into high-quality dividend growth assets. Turn on DRIP, Dividend Reinvestment Plan, inside your brokerage account. This removes human emotion, fear, and greed from the equation entirely. When the market dips, your reinvested dividends automatically buy more shares at a discount. Step 3. Map your dividends against real-world expenses. Gamify your financial journey. Don't focus on becoming a millionaire overnight. Focus on covering your monthly bills with passive cash flow, one brick at a time. Level 1. Your dividends cover your monthly phone bill, $600 a year. Level 2. Your dividends cover your grocery bill, $4,000. Level 3. Your dividends cover your rent or mortgage, 20s and more. Once your passive cash flow covers your basic cost of living, you are functionally free. You no longer work because you have to, you work because you choose to. True financial independence isn't loud. It doesn't flex rental sports cars or flash temporary luxury on social media. True wealth is quiet. It is sovereign. It is the peace of mind that comes from knowing your lifestyle is fully supported by assets that generate cash while you sleep. Buying 1,000 shares of a company like Johnson & Johnson isn't about bragging rights. It's about building a fortress around your family that no inflation spike, economic recession, or corporate layoff can destroy. If you are tired of playing short-term financial games that leave you exhausted and broke, it's time to change the game entirely. Focus on long-term wealth. Focus on cash flow. Focus on building an empire of assets that outlive you. If this video shifted your perspective today, hit the like button and subscribe to Economy Decoded. But more importantly, take one concrete action today to start building your passive income engine. Comment below, What is the one boring stock you rely on for long-term cash flow? I'm Economy Decoded. Thanks for watching, and I'll see you in the next breakdown.